let's get going. So we've used this session for the last 4 years to sort of take the pulse of private equity and try to assess what role it's playing for mining companies today. And clearly with the erratic capital markets and the relative scarcity of debt, private equity has been a very important player. And in response to that, a number of specialist private equity funds have grown and gone through second and third rounds of funding in some case, and also we've seen the introduction of mining as a component of some of the generalist private equity firms as well. But the 4 firms that are represented on the panel today are some of the, I think, the most active players in the industry, and I think give you a sense of the spectrum of private equity focuses. And what we're going to do is to look at what are the issues that are really of concern to the private equity firms and therefore try to assess what that means for mining companies that are looking for finance from this source. So I'm going to introduce each of the speakers really quickly and ask them to give a brief summary of the nature and background of their funds. So I guess starting on the far side, Bert Koth is Managing Director and Partner at Denham Capital, responsible for their mining investments, now based in Perth. Before joining Denham, Bert was at BHP, ING, and Deutsche. So Denham in 30 seconds.
In 30 seconds, okay. Well, I mean, we have a dedicated mining investment program and a dedicated mining fund. We've invested to date $2 billion in metals and mining. We execute what we call a back management team approach that's taken from the US oil and gas private equity world, where basically the fund backs management operator teams on a private basis to go out, buy the assets, create value, and then put these assets up for trade sale. That is in metals and mining, private equity, an unusual approach, but that is what we do, and that's the way how $100 billion of US oil and gas private equity get deployed. That was longer than 30 seconds.
No, that was close. That's good. That's good. Next to Bert is Dan Wilton, who's a partner at Pacific Road, based in Vancouver. And before joining Pac Road in 2013, he had about 20 years of M&A experience in the mining sector and financing, including a stint as the head of global mining and metals at National Bank. So Pac Road.
Pacific Road manages about $800 million in 2 funds, the first of which was raised in 2006, 2007. So 10-year track record of investing private equity in the mining space, and tend to focus on later stage assets. A lot of focus of our last fund was construction financing. No real specific commodity focus, but I'm sure we'll talk over the course of the next half hour about things we like and things we don't.
Ross Bhappu is a partner and head of private equity funds for Resource Capital based in Denver. And Ross, you've been with RCF since 2001, so quite a long time. Before that, you were president of a development stage copper company and had roles at Newmont and a variety of other mining companies. So RCF, probably one of the longest running private equity funds. What's the story on RCF today?
Yes, RCF pioneered the whole concept of private equity in mining back in 1998. We currently are investing our 7th fund, have somewhere in the neighborhood of $3.5 billion in assets under management. Historically, we've invested in 50 countries and 30 different commodities, so very diverse geographically, very diverse by commodity, and also very diversified by stage of development. So we'll do everything from exploration all the way through to buyouts of existing assets. And like Pac Road, we're very focused today on a lot of construction financing. That's where we see the biggest need, and so I'm sure we'll talk a bit more about that.
Great. David Street is a partner and one of the co-founders of Tembo Capital based in London. And before founding Tembo, David had 15 years at Rothschilds and SocGen and 5 years at Endeavor. Tell me a bit about Tembo.
Yeah, Tembo is a relatively new organization compared to some of the others on the stage. We started the firm off in 2014. We've raised 2 funds so far, and we're busy deploying that capital. First fund was largely focused on Africa. The second fund has been more emerging markets focused, long-term investment approach. Both the funds are 10 years, closed-ended. And we look to partner with companies, take strategic positions in those companies, and hopefully grow them over a period of time.
Great. All right. Well, let's dive in. I will say, if people want to get really exercised about anything anybody's saying, feel free to hold up your hands. Otherwise, we'll try to find a few minutes for questions at the end. So if you're a mining company and you're looking at raising some money, you've got a range of potential financing options. So I guess the first question is, when and why should you come to private equity? And I guess, what does private equity bring to the party? Maybe I'll ask Dan to start us off on that.
Sure. I think first and foremost, we are equity investors. We will often structure our investments in different ways to try and suit the opportunity and suit the need of the company we're investing in. But we are equity investors first and foremost. And I think when do you come to a private equity investor? Typically for us, I can't speak for everyone on the stage here, but it's usually when you need a larger source of committed capital that can take a longer term perspective and help you build your business. So we're not really good at putting in $1 or $2 million into a $10 million financing, but we're very good in the right opportunities and the right situations of putting $40 to $100 million in to help a company build a mine, or help a company refinance a balance sheet that it might need some longer term, more patient capital than what they have.
Right. Guys, do you agree with that? I mean, how does it compare with going to a streamer or going to a royalty company? Do you feel you've got more ongoing involvement in the company? Is that a plus or a minus?
Yeah, look, I think in the case of resource capital funds, we do take an active role. We view it as a very strong partnership with the management teams we deal with, so we do take a very active role with them. Look, I think private equity can be quite diverse in how it invests. So, whether it's straight equity, whether it's convertible debt, whether it's royalties and streaming, we'll take a piece of the entire capital structure really in the way we invest. So it's horses for courses, and it's trying to identify what is the right solution for that particular project and company. And that's how we think about it. And given the life of private equity being typically 10 years, we think that's a very nice time horizon that marries up very nicely with advancing projects through development and adding value along the way. So right. We think it's well suited.
Right. And do you feel that you are, obviously, you're now facing more competition from some of the other players like the streamers? Is that you're still finding that there's lots to invest in? Do you still feel, we've heard you've got $3.5 billion under management at the moment. Do you still feel that there's a steady pipeline of things coming down the track?
Yeah, look, our primary competition has been the equity markets. So it's the Toronto Stock Exchange, the Australian Stock Exchange, London's AIM market. We've had no shortage of deal flow. So just maybe to put it in perspective, over the last year, we looked at about 680 different opportunities, distilled it down to about 400 that were eligible sort of for the private equity type investing. That totaled about $17 billion worth of opportunities that we evaluated. So again, there's no shortage of opportunities in our mind right now. And given where equity values are, we're seeing great value. And I think mining companies, typically the junior companies, are having a hard time raising money on the equity markets, the Toronto Stock Exchange, the AIM market, and the ASX. So it creates great opportunities for the four of us sitting up here.
Right. Maybe Bert and David, I mean, in terms of the spectrum, is it fair to say that it's just the development and expansion opportunities that people would come to a private equity firm for, or would you look at a wider range of situations along the spectrum of financing? I don't know, David?
From our perspective, I think we are prepared to take a view a little bit earlier than some of our competitors. I think we would rather, we employ quite a few geologists. I think we would rather take more of a view on the technical aspects and the resource upside. I think we probably, on balance, would rather invest in a relatively new story, which we think has some upside and some resource growth in it, rather than something that was kicking around in the last cycle, didn't get financed then. Maybe it works this time. I think we would like to sort of work with companies a little bit earlier than just the construction phase, and we like to help them with their strategy and to grow the company successfully. And I think we're prepared with the technical people we have on staff to take that slightly earlier view to partner with people at an earlier stage. That said, we don't really do completely grassroots exploration, but we would go a stage or two before a feasibility study.
Right. Bert, I think you take a different view, would you?
Well, I mean, we typically underwrite the journey to cash flow at the moment in the current market. So our typical entry point is 2 years away from production. In some cases, skills are in some cases already producing. And the reason for that is, as a private equity firm, like I assume everybody else here on this panel, are ultimately exit incentivized, right? So every fund got an IRR hurdle building up, whatever 8-10% it is on every fund. So, you know, after 3 or 4 years, you know, at least a significant number of your portfolio companies, you got to get out of them, right? To actually get the fund in the profit. Now, then the next question becomes, how can you reliably do that? And if you look at the current M&A market, 87% of all consideration in mining assets since 2012 has been paid for producing assets, right? So ultimately, if you wanna be sure that you have enough to sell, that the fund makes profits in the current market, is for us at least, translates into actually generating producing assets that people will want to buy. That then reverse engineers into our investment strategy, which is basically getting assets into production. Yeah? Only tiny fraction of the M&A universe is paid for exploration and pre-production assets. It's not what people want to buy at the moment. Therefore, we are not producing it.
Right. Let's flip it around a little bit. If a mining company was a job applicant coming to you, trying to raise money for a project, what would be the one thing on the CV that would get them in the door, and what's the one thing on the CV that would drop them to the bottom of the pile when you're going through the hundreds of deals that come across the table? What are the things that immediately catch your eye and say, yeah, this is worth looking at?
For me?
Well, you can start. Sure, Bert, go for it.
Well, I mean, your question with the CVs, I mean, in our case, probably particularly relevant since we have a management team approach. So actually, we do start with people, and we analyze very carefully what they've done before. What makes us tick is that management teams have, with who we spend time with as potential candidates for funding, that they have a history of actually creating value and ideally monetizing value and developing the types of projects that we seek to get developed in the business plans we want to fund. So that's what gets their feet into the door. What gets them out of the door pretty fast is if they come up with beautiful promotional stories that just don't add up. That's
Dan, what do you think?
Yeah, you know, part of it, and this is born of some hard lessons, is, you know, plays well with others. And it sounds a little bit crazy, but, you know, the number of people who are super great partners and really value long-term commitment until you've signed the check, and then all of a sudden you're just another shareholder. That kind of doesn't really work for us. You need to find someone who actually appreciates having a sounding board, having someone who's really committed and invested in the company and really interested in the outcome. So, and that's not everyone. I mean, a lot of management teams want blind capital that they don't have to feel that same level of accountability to. So it's if you find a team that has that sort of predisposition and understands, you know, partnership, is looking for that, then that's a great check mark in our books.
We take a different approach. I mean, the biggest criteria for us is the quality of the resource. So if if a CV walks in, if a project comes through our door that the quality of the asset's not high, that's the deal killer for us. So we start with the resource, and then we look at all the technical aspects around that. But we also do a very detailed skills analysis, skills matrix of the management team, and really try to understand what parts of the management team are weak, what are strong, and how can we enhance that team to build success. So at the end of the day, you can't change the resource, but you can change management. You can change lots of other things about the project.
Yeah. What about in a public company situation? Would you typically look to put somebody on the board, or is that a case-by-case situation? I don't know.
It's a case-by-case situation, but generally, on the whole, we would look to have someone on the board of most of the investees, companies that we've invested in.
So you've done this deal with Orion that coincidentally had a really great write-up about Tembo in this week's Mining Journal. Did you have somebody on the board there, or is that something you would think
Not
about?
yet, but we have a right to put someone on the board at some point on that one. But it's not on every company, but it's a case by case. But we do often we try and agree that at the outset.
So management's clearly critical, I think, in different ways to all of the private equity firms here. In terms of where you're going to invest, in terms of, let's look first at geographies. Obviously, the last year has seen some interesting developments on the political risk side in countries like Tanzania, the reworking of mining codes or potential reworking of mining codes in places like the DRC. Has this changed your philosophy? Are there any countries that have dropped off the list? Are there parts of the world you wouldn't go to, or conversely, places that you're happier with going to? The previous panel was talking about how wonderful Australia is, and clearly Australia and Canada, developed markets, have a lot of pluses in terms of political stability. But I'm interested in knowing what your view of risk was and where you see countries that you will or won't invest in at the moment. Anyway, Bert?
Well, I mean, probably like in everybody else's portfolio, I mean, the majority of the capital is in benign countries like, kind of Australia, Canada, Chile, right? And look, mining is a difficult business, right? I mean, every place got its certain issues, every project got its issues. The question is, do you have the confidence yourself that you can overcome them, right? What's more damaging? Some complicated legislation in Canada, all of a sudden a super profit tax in Australia. When you make the bottom line analysis, country risk is whatever percentage of a value you lose to country-specific events, right? Yes, there are for sure a number of places where we wouldn't go. I mean, obviously we back management teams, so which management teams we back and where we're comfortable and where we're not comfortable is also informed by the history of management, who we back in certain places. But for our fund, I would say, very extreme countries in Africa, we wouldn't go, also quite careful about, let's say, the former Soviet Union, rightly or wrongly. But, honestly, in a mining fund, one shouldn't have a lot of no-go areas. I mean, resources are where they are, right?
Yeah, that's kind of the challenge. I mean, we've invested in a lot of places that people would raise their eyebrows in, significant portions of the fund in some frontier jurisdictions. I think we've learned some lessons having helped build the largest mine in Kenya. There wasn't, there's not a really well-established mining culture. We've been through a number of mining ministers, and, that can be difficult if you're the one who's having to provide a lot of that education to the governmental infrastructure. So we really, at the outset, when our founders raised the first fund, they kind of agreed with our limited partners, there's red countries and green countries. And I was really surprised at the distribution of those, because the DRC was a green country and France was a red country. So it kind of makes you wonder, but it's rule of law and it's mining culture, and is it a place from a socioeconomic perspective, from a country political will perspective? Is it a place you want to have a mine, or are you going to have a bunch of people making permitting difficult while you're there? Yeah. So it's an interesting balance.
Yeah. Ross, in terms of the risk assessment process, what do you do at RCF if you're thinking of going into Guinea-Bissau or something? How would you? Yeah,
we're pretty, as I mentioned at the outset, we've invested in 50 countries around the world, so we've had a lot of experience analyzing and assessing geopolitical risk. We have a team usually that goes in, led by our general counsel. She's had a lot of experience living in various parts of the world, and she'll lead a team, spend about 2 weeks, really meeting with government officials, international banks that are there, international accounting firms, lots of expats on the ground in the country, and really try to assess what is it like to do business here. And at the end of the day, what is the security of title going to be like? And then we as an investment committee make a decision as to whether we've appropriately priced the risk in that deal. And so that's what it sort of distills down to. Now, we have taken out political risk insurance in the past, where we've gone into a country we're not really comfortable with, but we like the asset and we think it's going to be okay. So that's readily available, and we have taken out political risk insurance. And although we've never exercised on it, we've never had to call it, but it is nice to know it's there.
So going from so that's sort of looking at the macro issues of the country. If you're looking at an individual company, what's the sort of diligence process that you go to, and how quickly can you move? I think one of the potential advantages of a private equity fund is the ability to move more quickly, I think, than some of the larger banks and some other investors. David, what's your experience in being able to move quickly on things?
Well, we did a transaction about a year ago, which was pretty quick by private equity sort of standards, which was in about 6-7 weeks, really, from seeing the opportunity. This was a company called Aero Copper, which is since listed in Canada. That was a private opportunity. We liked the people, we liked the asset, and the presentation initially. We felt that it was something that we should spend quite a bit of time on. So we focused people onto it quite quickly. Had a site visit very quickly within a few days. We liked the asset. We did a lot of legal work on the structure, on the title. It was an asset that was coming out of a restructuring process, so we spent quite a bit of time on the legal side of that. But essentially, we went from nowhere to doing the deal in 6-7 weeks, which is I would say very quick. We don't normally sort of do things quite that quickly, but it ticked a lot of boxes straight away when we saw it. Other things, both to look at the asset technically, also to spend time with the management, I think, which is quite important. So that's an example of how quickly it can go. Other occasions, we've started talking to a company, and then a year later, we've done a transaction. Something needed to happen, or two companies merged. We then did a transaction with the resulting company. So it's good to start the dialogue off early, I think. But I think so it's something that's interesting. I mean, if the market improves next year, we see things sort of on a Thursday, and the broker will say, "Well, can you close it on Tuesday?" And obviously, we can't do that. That's just not the way we're set up with the processes that we have. So if people do want to engage with private equity groups, it's good to start the conversation early, I think.
In terms of the internal approvals, once your management team has decided that this is a project that you think is attractive, is there any need to go back to the limited partners to get approval on any of these deals, or beyond a certain level, or can you, as a management team at your funds, make the ultimate call yourself? Obviously, within a larger organization, you're going to have an investment committee that's going to vet the decision that the frontline people want to take. But
we can. I mean, within the partners of the organisation can decide on a transaction amongst themselves up to a certain level. Yeah. Right. And if we want to bring outside investment in from one of our LPs, then obviously that's a bit longer process. Right.
I mean, I think on this panel here, everybody's a partner in the firm, so the partners in the firms can take these decisions. Yeah. I mean, for example, we have 4 partners in the current mining fund. Yeah, and there's unanimous decision making, but that's not a bureaucracy. I mean, we just get together and we figure it out. I mean,
if you're looking at larger situations, there's obviously, you've got a significant amount of money to be able to deploy yourself, but would you look at co-investment situations? I know Pacific Road and RCF, for example, have done some things together, but what about doing deals with strategics, or doing things with sovereign wealth funds, or doing things directly with your own investors? In other words, if the company's got a project that could be not needing 50 million or 100 million, but if it needs 750 million or 2 billion, how does private equity cope with that?
So we have actually quite an active co-investment program, and we've partnered up with Tembo as well. So we've partnered up with other PE funds, but we've also, currently we have a very active program with our LPs, with our investors. So we do quite a bit of co-investing where our limited partners will also co-invest alongside us to help raise large sums of money for those types of projects. So it varies. If it's really big, we'll bring in another fund. But if we can keep it in the family, so to speak, with our investors, we'll do that as well.
Yeah, I think as long as there's a good alignment of interest amongst the investor group, and that's the one thing that we really like investing with other like-minded private equity funds, is because typically we have similar time horizons. It's not like you're going to have someone with a one-year horizon who's going to have to get out of the investment, sooner than the investment thesis is going to take to mature. So having aligned interests is great, and actively look to find things we can take out to our limited partners. They're all interested in coming in alongside us and kind of relying on the diligence that we do. And it's, yeah, I think for tackling bigger projects, it's a great sort of source because there is a real level of comfort between a bunch of the types of funds that are on the stage here.
It's interesting. I actually heard one of the CEOs of one of the streamers recently worrying about bringing some of their investors into deals as they felt they were trying to develop their own internal expertise and wondering whether they were creating competitors for themselves. But obviously, you guys feel more comfortable with your existing limited partners.
We've seen this in oil and gas private equity. There's a huge oil and gas private equity universe that's $80 billion deep, and the LPs develop their own capacity. It just doesn't compete typically alongside us. So if metals and mining follows a similar trajectory as oil and gas private equity, nobody will know it will, right? I do not see this as undermining the private equity model.
Right.
No, in fact, the generalists will always might be a strong word, but almost always rely on real sector expertise in order to provide the due diligence necessary to have comfort to make the investment decision. Because the most difficult thing that they can do is underwrite a resource, right? Underwriting geostatistics is really hard for someone who doesn't live and breathe it all day long. Yeah. And that's why you've seen, I think, a real challenge for generalist private equity moving into the metals and mining space. Even Denham's done a great job with their model, but they've brought expertise in underwriting that resource, because if you get, more traditional, even energy funds kind of trying to move into mining, it's a lot harder to underwrite a mining resource.
Yeah, absolutely.
Right. Well, what about preferences between public and private situations, or are you agnostic about that? Maybe I'll start at Bert, 'cause I think you've clearly indicated a preference for private situations.
Yeah, no, we are by and large a private control investor. We back management teams that they buy projects and develop them. There's a few exceptions to that in what we do, but 90% of our capital goes into that kind of type of transactions.
Yeah, I mean, we have a strong preference for private transactions and private assets. That's the expectation of our LPs, is that's what we're going to look for and that's what we're going to invest in. The challenge is that 90% of your opportunity set in the mining sector, just by virtue of how venture capital is formed for mining, which is typically in the public markets, 90% of your opportunity set is public when you see it.
Right.
So we're completely agnostic. We're really indifferent to whether it's public or private, as long as it meets certain hurdles for us.
Right.
We'd probably prefer it to be a private company, but in reality, we've ended up doing about 50-50 public and private companies.
Right.
And a couple of those private companies have IPO'd or will do soon. Right. So I think it's more important to back the better teams and the better projects, really, rather than the structure.
Right. And in terms of exit, I think, Bert, you started the conversation talking about the need to harvest at some point. You've got a relatively long time horizon. Ross, you mentioned up to 10 years, but at some point you have to realize on the investments and what's been the experience in the last couple of years, and where have the exits come from?
For us, it's been slow. I mean, the exits, that's sort of the beauty of private equity, is we're not a forced seller at any given time. So we can hang on to these assets and look for good liquidity in the market to sell into. When we need to sell, we can sort of force the liquidity to appear, so we can sell. Problem is, are you going to get the value that you really want? And that's the challenge, is if you're a forced seller, then you're going to be subject to whatever the valuation of the market is. So we're try to be patient and try to look for exit opportunities as they appear.
Right.
I mean, the last few years in general, I think it's fair to say for metals and mining private equity have been challenging on the exit side, right? Because for single project juniors, the average valuation decline has been more than 90%. Now it's recovered somewhat, right? But this has been a kind of like in a once in a 20-year kind of valuation meltdown, right? So obviously not the right exit environment over the last few years. So there's exits of few in between over the last few years.
Well, we could probably carry on, but I see we've got 44 seconds left, which is time for a question, if anyone's got a question. Oh, a couple on. Here first.
Question to the panel for a quick answer. level of exploration has halved over the last decade. Are you still seeing adequate deal flow? Are there enough deals, or why aren't you in Zimbabwe today?
I'll start that one. We actually made an allocation to early stage exploration for that very reason. We saw that there's a lot of great exploration opportunities, great management teams that were really struggling to find money, and so we made an allocation within our fund to do that, and so we do have an exploration portfolio within our fund.
I mean, our approach to exploration is once we have an asset in production, it's cash flowing, we take a small slice of that cash flow to actually risk it on exploration. But we would not assume outright binary equity risk on exploration. So we wouldn't issue a cash call to LPs to fund exploration activities. We fund it out of cash flows of producing assets that we own.
All right. I think there's another question over here next.
So I think Dan WIlton was mentioning that in terms of pricing, it's all about valuing risks, and so to take things to an extreme, maybe what kind of WACC discount rate would you, both of you, use for a gold mine in the DRC?
I think it's not the discount rate, it's the return that you're gonna get, right? So these days, let's say in Australia or in Canada, you can make on a large amount of capital 3 times your money back. If you can't make 6, 7 times your money back in the DRC, don't even book the plane ticket.
I think it's probably I kind of echo Bert's sentiment. I think it really is kind of an overall return for the risk that you're taking. We look at relative valuation benchmarks on gold projects as the industry does, typically with a 5% discount rate, but it ultimately comes down to if you believe the company's going to execute on the game plan that they've articulated, and or the resource turns out the way that you think it's going to, what kind of multiple return on cash invested do you think that you're going to get out of it? And I'd say that would need to be higher in the DRC than it would be in Quebec.
We probably have time for one last question.
Gentlemen, thanks for some profound insights. Great job today. And the microphone's, there it is. So two quick questions. One, did you bring plenty of business cards, and may I line up to have one? That's first. And second, we've seen a lot of focus in the energy metal space of late, with particular regard to lithium, something near and dear to my company's heart. We all know the demand side growth. We've all seen the flurry of activity in expansion plans for the majors, and many juniors jumping into the race and identifying large potential sources. The elephant in the room that nobody seems to talk about is what some analysts project could be as much as $1 trillion that's needed to deliver all of these projects into production to satisfy the projected demand. Why is private equity taking so much time, along with in consumers, in offtake agreements, et cetera, to meet that amazing opportunity and what at least some predict as perhaps one of the fastest commodity growth opportunities in the past century?
I give you a very cynical answer. Last time when everybody believed that everything will keep on growing, like in the Chinese super cycle, the end result was that a lot of people lost 60 to 70% of their money when China's growth story ended. So if you believe on a permanent growth story to make money, you better not invest. It's got to make money under today's paradigm, my humble opinion.
Look, we're excited by the battery metals, and we're looking at a lot of different investment opportunities there. We've been big investors in lithium in the past. And look, we continue to look for opportunities in that space, but I think we're very cautiously optimistic about it, and I think we're not getting too aggressive with our investments in that space just yet.
Well, I think we're out of time now, but I should all to thank the panel for their time in the traditional way.
Thank you.